Welcome to vTalkInsight, Risk Sentiment Daily for January 20th, 2026. Transatlantic trade tensions have pushed markets into a distinctly risk-off stance, with European equities under pressure and safe havens back in favor. Let us unpack what is driving today's risk sentiment and where the main fault lines now sit. Compared with last week's broadly constructive tone, today's mood has swung decisively toward risk-off. Equity indices are retreating, led by Europe, while safe haven assets such as gold, the Swiss franc, and selected defensive sectors are finding strong demand. Volatility is higher, and investors are clearly paying up for protection against further policy and geopolitical shocks. The epicenter of stress is Europe, where renewed U.S. tariff threats and the prospect of EU retaliation are weighing heavily on exporters, especially autos and luxury goods. Broad European benchmarks are down over 1%, with sectoral divergence. Banks, technology, and consumer names are under pressure, while utilities, grocers, and defense stocks are showing relative resilience as de facto havens within equities. Flows and positioning reflect this defensive tilt. Investors are rotating toward metals such as gold and silver, into the Swiss franc and short-dated German bonds, and into sectors viewed as insulated or even benefiting from higher defense spending. At the same time, there is little evidence of outright panic. Instead, the pattern is one of de-risking and hedging rather than a wholesale rush for the exits. Escalating US-EU trade war risks are the core bearish driver today. The United States plans to impose new tariffs of around 10% on 8 European countries from early February, with rates potentially rising to 25% by mid-year, while the European Union is preparing retaliatory measures on close to $100 billion of U.S. goods. This hostile trajectory leaves European exporters squarely in the crosshairs. Luxury brands, autos, and other high-profile sectors are already trading lower on expectations of reduced pricing power, supply chain disruption, and possible consumer boycotts. Business leaders expect tariff volatility to persist through December 31st, 2026, prompting them to rethink business models and pass higher costs down the value chain. Political dynamics add another layer of uncertainty. European leaders have condemned tariff threats linked to issues such as Greenland as an illegitimate use of economic leverage, while protests in Denmark and Greenland and talk of increased military presence in the Arctic underscore how economic frictions are bleeding into security concerns. Markets fear not just higher tariffs, but also the risk of policy missteps as public pressure builds on both sides of the Atlantic. For portfolios, that translates into higher risk premia on European cyclicals and a persistent valuation discount where earnings are most exposed to U.S. demand. Investors are likely to keep testing how far policymakers are willing to go before stepping back from the brink, so headlines on tariff negotiations and any signs of compromise or escalation remain the key catalyst to watch. Beyond the headlines, trade-driven inflation and corporate stress are emerging as a distinct concern. Rising tariffs on European exports to the U.S., combined with already elevated corporate leverage, are squeezing cash flows for multinationals with large American operations, while more than 60% of tariff costs are now estimated to land on U.S. consumers. That cost shock is feeding directly into business confidence. Executives, particularly in Europe, report that trade uncertainty is severely constraining long-term investment decisions, from pricing and capital expenditure through to supply chain design, leading in some cases to a near paralysis in strategic planning. At the macro level, the risk is that companies pass higher costs through to end buyers, generating pockets of inflation even as growth momentum softens. European business leaders already warn of likely inflationary consequences, which could complicate the task for central banks that are being urged to act as stabilizers and may need to balance further easing against the optics of tariff-induced price pressures. The implication for markets is greater dispersion within and across regions. Companies with pricing power, diversified revenue streams, and lower leverage may be better placed to absorb the shock, while highly indebted exporters with concentrated U.S. exposure face rising downgrade and refinancing risk. Earnings season and guidance on margins, price pass-through, and capital spending will be critical signposts for how this stress is evolving. Layered onto trade tensions is a quieter but important trend: de-dollarization and shifting capital flows. Central banks are gradually diversifying reserves away from the US dollar toward gold and, in some inflation-prone countries, even Bitcoin, partly in response to recent episodes of asset freezes and sanction risk. Europe is central to this story as well. European governments collectively hold around $8 trillion of US assets, and there is growing discussion about trimming that exposure, while private investors in Europe are already diversifying away from US treasuries and equities, often after years of running unhedged dollar risk. Currency markets are starting to reflect this shift, with the dollar weakening against major peers and the euro strengthening as investors build in a higher political risk premium for US assets. That creates a two-sided backdrop. Emerging markets such as China, Korea, Taiwan, India, South Africa, and Brazil may benefit from a weaker dollar and portfolio diversification flows, but U.S. funding markets could become more sensitive to episodes of risk aversion. For cross-asset allocators, the key is how official and private flows evolve from here. Clear communication from U.S. policymakers, shifts in hedging behavior among allied investors, and any acceleration in central bank reserve rebalancing will influence both currency volatility and the relative valuation of U.S. versus non-U.S. assets over the coming quarters. Set against these macro headwinds, robust private markets and private credit stand out as a key bullish counterweight. Private fundraising reached about $23 billion last year and is targeting $25 billion this year, with expectations of an acceleration supported by a flagship secondary fund and strong demand for liquidity solutions. Within that universe, secondary private equity and private credit are drawing particular interest. Secondary transactions are seen as attractive because slower exit markets increase the value of earlier cash flows and diversification, while real estate debt and asset-backed private credit are benefiting from reduced lending by regional banks, creating room for alternative lenders to step in. More broadly, private capital is being framed as a stabilizing force in a world of deglobalization and policy shocks. Patient, long-horizon strategies can absorb volatility in public markets and help finance needed restructuring in sectors hit by tariffs or regulatory change, even though investors remain cautious around mid-tier credits where risks are less transparent. The practical takeaway is that, despite cyclical uncertainty, appetite for private assets and private credit has not disappeared. It is evolving towards strategies that emphasize downside protection, earlier distributions, and structural growth themes. How managers execute on segmentation, underwriting standards, and alignment of incentives will determine which platforms are positioned to benefit most as the current macro cycle plays out. A second constructive driver is AI and blockchain-driven productivity gains. U.S. productivity growth has already risen from around 1% to nearly 2%, with expectations of further upside for companies that successfully embed artificial intelligence into their operations and business models. Financial institutions are at the forefront of this transition. Major banks like HSBC are investing heavily in AI and quantum computing to improve trading efficiency and accuracy across asset classes, while also signaling a desire to redeploy, rather than simply reduce, headcount by shifting staff into higher-value client-facing roles. At the same time, blockchain is moving from the margins toward the core of financial infrastructure. Traditional institutions are increasingly engaging with crypto and decentralized finance, with blockchain-native money market funds demonstrating lower operating costs, daily interest payments, and seamless transfers into stablecoins, all of which highlight the potential for disruption in traditional asset management. This innovation cycle brings both opportunity and volatility. Sectoral leadership is likely to keep rotating as markets differentiate between firms that genuinely capture AI and blockchain productivity gains and those that merely talk about them, suggesting a fertile environment for active stock selection and thematic strategies focused on real, measurable efficiency improvements. The final bullish driver is selective regional policy and growth support. Gulf economies are highlighted as compelling long-term destinations, underpinned by strong sovereign balance sheets, ambitious economic transformation agendas, and maturing private equity ecosystems, while several emerging markets stand to benefit from a weaker dollar and global portfolio diversification. Developed markets are also generating pockets of optimism. In the United Kingdom, the government is promoting a new golden age for London's financial sector, backed by strong inward investment and streamlined listing rules that cut prospectus requirements and lower capital raising costs, while in Japan a temporary reduction in food sales tax signals potential fiscal stimulus to support consumption. Monetary policy flexibility adds another layer of support. European policymakers emphasize the role of central banks as stabilizers amid trade tensions, with the European Central Bank keeping the option of further rate cuts if tariffs hit growth and inflation materially, and investors closely watching upcoming decisions from the Bank of Japan and the Bank of England alongside key inflation and growth data. For global allocators, these regional stories suggest that, even as headline risk rises, there are differentiated paths for growth and policy across markets. That opens the door to more nuanced regional rotation and diversification strategies, with attention on where domestic reforms, fiscal capacity, and external tailwinds can offset some of the drag from trade and geopolitical frictions. To sum up, today's backdrop is decisively risk-off, driven by escalating US-EU trade war risks, rising trade-related inflation and corporate stress, and a gradual shift in global capital away from the dollar. Yet alongside this, robust private markets, sustained AI and blockchain-driven productivity gains, and selective regional policy support in the Gulf, emerging markets, the UK, and Japan are creating pockets of resilience and potential differentiation. Staying focused on how these forces interact across regions, sectors, and asset classes will be critical as the year unfolds. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.